Imagine walking into a high-end corporate boardroom where a group of elite hedge fund managers, commercial real estate developers, and tech executives are staring at a massive, multi-billion-dollar cash flow chart. They are not looking at software licensing metrics, pharmaceutical patents, or semiconductor shipping logistics. They are looking at the velocity of milk, sugar, and automated espresso pumps. To the untrained eye, Starbucks is simply a massive fast casual food and beverage chain that happens to have a highly popular mobile application. But if you peel back the layers of its corporate balance sheet, with the clinical detachment of a Wall Street short seller, you realize that treating Starbucks like a standard restaurant group is a fundamental economic misunderstanding. In reality, Starbucks is a highly sophisticated, multinational real estate investment trust seamlessly fused with a completely unregulated, interest-free shadow bank. It is an economic fortress, engineered to capture consumer capital before a single coffee bean is ever roasted. If you are an aspiring entrepreneur dreaming of starting your own business empire by opening a local Starbucks on the corner of a busy metropolitan intersection, you will immediately crash into a brick wall of corporate policy. In the United States and most major global markets, Starbucks does not offer traditional franchising. Howard Schultz, the visionary architect who transformed the company from a single Seattle bean roaster into a global cultural phenomenon, fiercely resisted the standard franchising model used by rivals like Dunkin' or McDonald's. He believed that allowing independent, third-party operators to manage individual stores would inevitably dilute the precise, carefully choreographed customer experience and ambient environment that defines the brand. Instead, the only path to physically operating a branded Starbucks location is through a highly exclusive corporate licensing agreement. To qualify as a licensed partner, you cannot just be an individual with a strong credit score and a few $100,000 in cash. You must already control a massive, pre-existing, high-traffic commercial ecosystem. Starbucks only grants licenses to major airport hospitality groups, luxury hotel conglomerates, massive university campuses, military bases, or national supermarket chains. Under this arrangement, Starbucks forces you to fund the entire capital expenditure of building out the kiosk, while retaining absolute control over the design, the digital point-of-sale infrastructure, the technology, and the menu. You are essentially renting their intellectual property and purchasing their proprietary syrups, cups, and beans under an incredibly strict operational leash, while handing over a massive percentage of your top-line revenue. If you do not sit atop a multi-billion-dollar hospitality empire, your only method of owning a piece of the Green Mermaid is through the public stock market, buying up equity shares alongside massive institutional investors. But regardless of whether you are analyzing the profit and loss statement of a single licensed airport kiosk or tracking the macro-level financial metrics of the entire corporate entity, the underlying economic engine relies on an aggressive, highly calculated asymmetry between consumer psychology and the physical physics of retail space. To truly understand how this engine prints money, you have to look past the cozy seating areas and analyze the raw cost of goods sold. The baseline economics of a standard, company-operated Starbucks location are genuinely staggering. A well-positioned corporate store pulls in roughly $2 million in gross revenue annually. In a traditional restaurant or independent coffee shop, food and labor expenses are a massive, volatile burden, typically consuming 60 to 70% of every single dollar that crosses the counter. This leaves paper-thin, single-digit net margins that can be completely wiped out by a spike in utility costs or a slow winter month. Starbucks, however, has engineered the production of specialty beverages into a hyper-optimized manufacturing line with massive markup potential. The absolute raw material cost of a standard cup of black drip coffee, the water, the paper cup, the cardboard sleeve, the plastic lid, and the roasted beans, is roughly 30 to 40 cents. When Starbucks retails that exact cup to a consumer for over $4, the gross profit margin hovers near an incredible 90%. Of course, the modern consumer rarely walks into a Starbucks to buy a simple cup of black coffee. Instead, the entire menu is mathematically designed to steer customers toward highly complex, cold, ice-blended beverages, loaded with custom syrups, cold foams, and non-dairy milk alternatives. These intricate drinks carry slightly higher material costs, but Starbucks compensates for this by charging exorbitant, compounding premiums for modifications. Charging an extra 80 cents to swap whole milk for oat milk, or demanding an additional 50 cents for a single pump of vanilla syrup, adds fractions of a penny to the company's internal expenses while adding pure, unadulterated profit straight to the final ticket size. Once you subtract store-level labor, the steep commercial real estate rent required to occupy prime corner locations, and utility costs, a standard corporate Starbucks maintains an operating margin of roughly 15 to 18%, walking away with over $300,000 in net cash profit per store every single year. However, maximizing these individual store margins eventually forces the company to confront a brutal operational ceiling: physical throughput. In the fast casual retail industry, your ultimate revenue cap is determined by how many human beings your staff can physically process during the peak morning rush between 7 and 9 in the morning. If the physical line wraps out the door and onto the sidewalk, or if the drive-through lane spills over into traffic, the psychological friction of waiting 15 minutes for a macchiato will cause consumers to abandon the line and seek out a competitor. To break through this spatial constraint, Starbucks spent the last several years executing a massive, silent structural pivot across its global real estate portfolio. They began systematically closing down their traditional, large-footprint sit-down cafes, the historic third-place environments filled with plush armchairs, soft lighting, and lounging customers with laptops, and replacing them with hyper-efficient, micro-footprint drive-through locations and pickup-only kiosks. By aggressively stripping away the seating areas and public restrooms, Starbucks achieved an immediate financial double whammy. They slashed their commercial real estate lease obligations by hundreds of thousands of dollars per location, and they drastically reduced the labor hours required to clean, monitor, and maintain the facilities. This structural evolution turned their physical real estate into high-speed, automated liquid assembly lines designed to extract premium margins from hurried commuters at maximum velocity. Yet this physical optimization is merely the stage for the true crown jewel of the Starbucks business model, the digital flywheel. This is the exact point where the company completely transcends the boundaries of the food and beverage industry and begins operating as a dominant financial technology monopoly. To completely bypass the processing fees charged by major credit card networks like Visa, MasterCard, and American Express, fees that quietly erode the margins of every small business on Earth, Starbucks constructed a highly gamified mobile application and rewards ecosystem. To unlock maximum loyalty stars, achieve elite reward tiers, and access free drink customizations, the system is engineered to heavily incentivize customers to preload money onto a digital Starbucks card before they ever enter a store or place an order. When a consumer opens the mobile application and transfers $50 from their traditional checking account onto their digital Starbucks account, an extraordinary accounting alchemy takes place on the corporate balance sheet. The moment that money is transferred, it is officially classified as a stored value card liability. It represents cash that the consumer has pre-committed to spend exclusively within the Starbucks ecosystem at some undisclosed point in the future. Globally, Starbucks sits on an absolute mountain of this preloaded customer cash, consistently holding a rotating balance of between $1.7 and $2.4 billion in digital deposits at any given moment. If Starbucks were legally classified as a formal financial institution, this staggering deposit base would rank it as one of the largest corporate banks in the United States, placing it ahead of hundreds of traditional regional banks. The hidden genius of this shadow banking operation lies entirely in the cost of capital. When a traditional commercial bank holds your deposits, they are subject to intense federal regulatory oversight. They are legally mandated to maintain strict capital reserve ratios, and they must pay you an interest rate to incentivize you to keep your money in their vaults. Starbucks faces absolutely none of these regulatory or financial hurdles. Millions of loyal, deeply habituated consumers willingly surrender billions of dollars in aggregate, providing the corporation with a massive, permanent, self-replenishing pool of completely interest-free capital. Starbucks can take this immense mountain of cash and immediately deploy it into the macro economy. They routinely use your preloaded coffee deposits to fund their aggressive global corporate expansion, acquire highly valuable pieces of commercial real estate, build out highly automated regional roasting plants, buy back their own corporate stock, or invest the cash into short-term, highly liquid financial securities to harvest millions of dollars in safe corporate yields. You are essentially granting a multi-billion-dollar multinational corporation a massive, continuous, interest-free loan, purely for the psychological convenience of ordering an iced latte 10 minutes before you drive past the store. But the monetary benefits of this closed-loop shadow bank run even deeper, crossing into an incredibly lucrative accounting phenomenon known as breakage. Human behavioral psychology dictates that when physical currency is converted into a proprietary digital token or locked onto a specific corporate gift card, its perceived day-to-day value drops in the mind of the consumer. People lose track of physical gift cards hidden in junk drawers. They delete the mobile application while leaving a floating balance behind, or they leave minor, fractional amounts, like 64 cents, sitting idle on their digital accounts because it simply isn't worth the temporal effort to scan and redeem it at the register. Over decades of operation, highly sophisticated statistical models allow Starbucks to predict with near-perfect mathematical accuracy exactly what percentage of those billions of dollars in digital deposits will never, ever be claimed by the public. Once a digital deposit crosses a specific timeline of total inactivity, accounting laws allow Starbucks to legally declare that money as officially abandoned. The company can then execute a simple keystroke, shifting that money directly from a balance sheet liability into pure, high-margin, top-line revenue. This breakage revenue is essentially free money, dropping directly to the bottom line with absolutely zero cost of goods sold, zero labor, and zero real estate overhead attached to it. In recent fiscal cycles, Starbucks has quietly pocketed over $200 million annually in pure breakage revenue alone, transforming consumer forgetfulness into an institutional profit center. The beauty of this financial loop is absolute. The company secures an interest-free loan up front. A predictable percentage of that loan is never paid back because the consumer abandons it, and the remaining active balance locks the customer into an absolute corporate monopoly where they can only exchange their digital tokens for highly marked-up coffee products. However, even this incredibly resilient digital flywheel is not entirely immune to the shifting, volatile macroeconomic forces of global supply chains and shifting cultural dynamics. The most immediate operational risk, threatening the long-term margins of the Starbucks empire, lies in the volatile nature of agricultural commodities and geopolitical climate disruptions. Arabica coffee beans are a delicate crop grown across a narrow geographic band known as the Bean Belt, encompassing developing regions in South America, East Africa, and Southeast Asia. Severe weather anomalies, prolonged droughts in Brazil, changing temperature profiles, and agricultural blights can cause the global commodity price of coffee to spike violently over a matter of weeks, squeezing the company's raw material margins. Furthermore, because the Starbucks brand identity has historically marketed itself on human connection and the welcoming demeanor of its baristas, the corporation is profoundly exposed to the complex shifting dynamics of the labor market. In recent years, the company has had to navigate a massive, highly coordinated wave of unionization efforts across hundreds of its corporate-operated stores in North America. Frontline retail workers, facing the intense physical and psychological stress of processing a non-stop, unrelenting digital flood of custom mobile orders during peak hours, have increasingly demanded higher baseline wages, predictable scheduling guarantees, and expanded store staffing levels. To combat this operational friction and protect their corporate reputation, Starbucks has been forced to inject hundreds of millions of dollars into elevated barista compensation and comprehensive benefits packages. To simultaneously offset these rising labor costs, The company has aggressively accelerated its investment in deep tech automation, deploying highly advanced, computerized espresso machines and automated syrup dispensers designed to minimize human error, reduce drink creation times by critical seconds, and gradually insulate the corporate bottom line from a heavy reliance on manual human labor. When you pull all of these disparate columns together on the global balance sheet, the macroeconomics of owning and scaling Starbucks reveal a business model of unparalleled capital efficiency. It is a corporate engine that has effectively decoupled itself from the traditional, low-margin limitations that plague the rest of the hospitality and food industry. By marrying the 80 to 90% gross margins of premium caffeinated liquids with a ruthless real estate strategy that prioritizes high-velocity, small-footprint drive-thrus, they constructed an incredibly profitable physical retail footprint. And by seamlessly overlaying that physical retail layer with a digital app ecosystem that captures billions of dollars in interest-free consumer deposits, while extracting hundreds of millions in effortless breakage revenue, they engineered a financial perpetual motion machine. It is a system where the consumer doesn't merely buy the final product. They willingly finance the entire corporation's capital expansion up front, one digital deposit at a time.